Welcome back to the ROI channel, a channel that's obsessed with the art and science of return on investment. And today it's going to be very brief, very strict, short time frame update on what I'm doing with the eToro portfolio, guys. So just a few little changes. Unfortunately, it's on the negative side. What we have to do as investors is use the facts or look at the facts as best we can, and then take into account if those facts change in terms of how we make the decision. So we've had some price changes on the downside for a few of our holdings. And today I'm going to go over why I have chosen to close some of the holdings at a paper loss and move that into what I believe is a much higher opportunity. And so let's get straight into it. The first one is Micron. So Micron here, as you can see, I have just gone through and updated a lot of the numbers. And if we take into account the previous entry price and I update it to the close as of last night in the US, instead of having an intrinsic value, if we use a cash flow valuation metric of over $100, now we're looking at a significantly impacted intrinsic value. Now, why has this occurred? This has occurred because Micron have taken advantage of the CHIPS Act, and with this decoupling of Chinese or Taiwanese manufacturing and the US stating that they are finally waking up to the security of supply when it comes to semiconductors, which is a crucial part of the global economic and defense supply chain. They are entering into a huge new era of capex, and this is where we don't want to be. This is the precise opposite of the energy situation at the moment, where the capex is at the lowest it has been in several decades when adjusted for GDP. We are seeing companies invest a lot of capex when it comes to semiconductors. And so with that lag time in, I don't know exactly, maybe 18 months through to 3 years, I believe we're going to see a glut of chips into the market. And so this is if you look at Marathon Resources, a great book, Capital Returns and Capital Cycles, we are right at the top in terms of returns, right at the coming into the top in terms of capex. And so this is not where we want to be. And so the facts have changed. And so we've taken close to a 20% hit on the position, which is only a couple of percentage points as a portfolio. I want to take that cash and I want to allocate it to somewhere where there's a dearth of capex, okay, a lack of capex, and that is, of course, in the energy sector. I've done it by buying oil futures. No leverage attached, so this can just sit simply on the balance sheet as a different form of cash, okay, in the way of oil futures. I've already spoken about where I believe oil is heading. Go back and see the previous video on Journey Energy, and you'll get an indication as to where I think we're heading. So as you can see, the intrinsic value over the next few years has come down almost by half. I've updated analyst expectation of their numbers, and it just doesn't make sense anymore compared to other opportunities. And so we need to be I need to be disciplined and cut the position and move that into a position that has much more promise. So that's the explanation with regards to Micron. This is the one here that I'm most conflicted about, which is Royal Mail. They've spun off into ISD. And so if you look at these numbers, it doesn't look terrible from a cash flow perspective. However, the problem that we're going to have, or that I anticipate that they are going to have, is that they are not really going to grow much on the top line. And I doubt, given the inflationary pressures in the United Kingdom, I really doubt that they are going to be able to maintain or increase their margins. And so if you have a business that is deep value, but it's not growing, you just think they've got a lot of cash and they have the ability to churn steady margins. And then we have an event in the macro economy that suggests that margins are going to be put under pressure due to inflation. Now, all of a sudden, the thesis really does need to change, if I'm honest. And so I've made the hard decision and I've cut Royal Mail from the portfolio. This has been the most disappointing performer year to date. And so we've just had to do it. It's a 40% loss on the position, which was calculated at about a 3% of the portfolio. So we've taken a 3% hit on the portfolio on this position, and I'm rolling that into opportunities that I think can give us a 20 to 30% return over the next few years. And so this is just how it is. The opposite argument might be that they still have a decent balance sheet, and thus their book value is, the company might be considered undervalued compared to its book value. However, again, we need to be attuned with what's happening with the currency environment in this macro environment that we're heading. Not only is this company going to have its margins smashed, its revenues potentially decrease as opposed to stay flat, but earning a lot of money in British pounds. The pound has just been absolutely murdered, guys, over the last couple of weeks. And there's every bit of evidence that that is going to continue. We're going to have a weak British pound versus the dollar, because the United Kingdom is in a terrible, terrible position when it comes to current account surplus deficits, current account FX holdings. So how much foreign holdings the UK has, it barely has any. And they are in a lot of trouble. And so they're going to have to devalue or allow the pound to devalue and stay weak in order to be able to, and this comes to the next point, import the energy that they need, because they're hugely dependent on energy imports. So the British economy does not look particularly strong, in my opinion, at the moment. Obviously, I'll keep an eye out for that. And so although it still looks like there is a decent amount of value there from the balance sheet perspective, I think it's a trap. I think it's easy for me to convince myself that, oh no, it'll all be okay, but I don't think that's the right way to play it. I think that that's more an emotional statement as opposed to a cut and dry logical fact. And so the position has been cut, and again, I'll be rolling that into other opportunities, which I'll explain in a future video. If in my other fund, I do hold some equities, but I have the ability to write covered calls. And so obviously I can take that premium and lower my entry price, or I can take that premium and buy other opportunities, or I can buy insurance on the stock. There are all sorts of different ways to play it. But in the eToro portfolio, I don't have that ability, obviously. And so I just have to make the hard decision. Simple as that. Overstock, again, the facts have changed. It's trading at a single digit free cash flow yield, if that, and look, it was a call option on Medici Ventures and the different potential venture capital businesses that they have. And it was a small part of the portfolio. I've just decided to cut it because, again, there is an opportunity for a 10-bagger potentially over the next few years. However, that's an if question, whereas right now I have a when question with regards to something like, say, a Synovus Energy, which will be almost debt-free, trading at 20 to 30 free cash flow yields, and that's a when question. That's a now question, and when will I get that money back? Management have already given me indications as to how they're going to allocate their capital, and it's just a far more certain, far more lower hanging fruit. So why am I going to hang out here in a single digit cash flow when I can simply roll that capital into something that's going to give it back to me one way or another, be it buybacks, dividends, or eventually the general market catching on and having to move capital to where you're actually getting a real return from a free cash flow basis, which is in the energy sector. And so there it is. There's a little update. That's the rationale. So the portfolio is looking fairly lean at the moment. It's been trimmed down to 33 positions. At the moment, this is where we stand in terms of the percentage allocation. The heaviest component is allocated to the uranium sector, but this is an ETF, so it's not one particular stock. Energy as a whole is 46% of the portfolio at the moment. We have, I believe, 16.73% in cash. And here we have some companies trading at ridiculously low valuations of the free cash flow, such as Arch. GoPro, I believe, will do very well. The narrative behind GoPro is simply that it's a consumer good. And so coming into a recession, there's a fear that people are not going to be able to pay to buy new GoPros, not understanding that this company's business model has changed quite a lot. This is more of a royalty style, Apple style software as a service company, where they sell you a bit of hardware, being the camera, upfront for basically no profit, and they make 70 to 80% margins on the back end with your subscription to their editing software, which is fairly cheap. It's around $50 a year, which shouldn't break the bank for many people, even in a recession. And if you're a diehard adventure sport person or a hiker or an outdoors type of person, you're going to buy GoPro. 95% of the market share goes to them. And so you're not, if you forked out $400 for a camera, you're not going to balk at the $50 a year to maintain your software subscription. So I do believe that this is a good business to own for the long term. We have our energy plays here, fairly straightforward. We have talked to the underlying commodity, and we have some high torque indebted plays, being Callum Petroleum in the US. We have an integrated powerhouse at Synovus Energy, very high free cash flow to enterprise value, very good balance sheet with refining upstream and midstream capacity. And we've got our oil services, agriculture, so on and so forth, which I've spoken about before. A few things to note here. I have started to build out plays into the metals section a little bit more. I think we'll see energy spike, and then we'll see base metals and agriculture, and then last but not least will be precious metals. If you look at the anatomy of a typical commodities bull run, and there are many reasons for that. So here you may notice a few new positions. I've simply started to slowly but surely build out the positions that I'm interested in terms of the metals sector. Okay, particularly if I can get access to a Jado type business where they can sell in US dollars and have their expenses in a weaker currency with a strengthening dollar, that is going to increase their margins. So they're going to get some margin expansion there. We still have plenty to go in terms of building out the tiny little portfolio down the bottom, but that is where the 16% cash comes into it. So I'm still very excited. The portfolio has like a single digit multiple on free cash and earnings. So we have definitely not overpaid for the assets that we currently own. And it's just up to me to keep an eye on it, have the facts change for any of the positions that we own. If not, we sit back and we collect the free cash flow and wait for the market to re-rate, or for us to simply earn our way, earn our investment back and earn a nice multiple on that investment. That's it for today, guys. Nice and simple. Any questions, leave them in the comments section. Otherwise, I look forward to seeing you in the next video.